Today, we're going to be talking about the magic of moving averages. Now, moving averages is one of the most well known, most well used technical indicator. Now, it's very simplistic, but it's also the basis for many trading strategies and for many other indicators. Okay, for instance, MACD uses a combination of moving averages. Bollinger Band uses the center line of a moving average. Okay. Moving averages help Forex traders make effective transactions by aiding them in evaluating the price history of a currency pair or related investment. More specifically, these averages make it easier for investors to interpret the price fluctuations of an asset by smoothing out their random movements. Now, if you believe like I do, and it is my deepest belief, that the markets are completely random. Absolutely. They're made up of millions and millions of human beings making God knows what decisions and how they're making those decisions. There are certain times that the market exhibits non-random behavior. When we can see these, we can then apply rules and make some smart trades. But most of the time, it is trading completely randomly. Moving averages is one of the tools that can help you take the randomness or the noise out of the markets. So let's pop up a chart here. Okay, now we're looking at my standard teaching chart, Euro US dollar 30-minute chart. And on it, you can see this blue line. Now we're going to change the settings of this blue line. We're going to make it 10-period moving average. And we can see that the Euro US dollar is actually been steadily moving in an uptrend. Came off of a downtrend earlier in this month, and now it's been recovering back to, amazingly, where it started to descend. But you see, price doesn't move in a nice, smooth fashion. Price moves up and down, up and down, up and down, up and down, up and down. A moving average simply takes that noise and all those fluctuations out of the market and makes it helps us see exactly what's happening. Because it happens to be in the Euro US dollar day, we can see very clearly on price movement alone what is happening. But a moving average will help us see the movement more clearly. It will help us see a trend. A moving average will also help us stay on the right side of price movement or the trend. With moving average, we call it red light, green light. Regardless of the time period of the moving average you're looking at, we would always or only take a buy scenario when the price is above the moving average. We would only consider a short or a sell scenario when the price is below a moving average. Breaking of the moving average can also tell us a shift in the trend. So it gives us lots of pieces of information. Now, what's a moving average? Moving average is a standard average, whether you're looking at the average in dress lengths or you're looking at the average, how many, size of apartments. We're going to take a random number of those. Say, for instance, we want to take the size of the average apartment on the main street in your town. So you say, I want to average in, every street has, say, 20 apartments. So I'm going to take 20 apartments on that street, add their square meters or their size together, and divide it by those 20 apartments. And that'll tell me what the average apartment size is in my neighborhood. And that's exactly what we do. If we're looking at a 10-period moving average, We're going to take the last 10 time frames. And when we're using a standard simple moving average, we would normally take the close. Okay. And the reason I say normally is today, modern computers and these wacky developers, and developers aren't traders. So these guys who develop the charting systems, the IT part, okay, think that they're giving us a lot of choices by giving us all of these things because they have them. So they can say, okay, doesn't take me any more programming anymore. If you want to take the moving average based on the open or the high or the low or the close, okay, doesn't make much of a difference. Does For all of my life, it was always a moving average, especially a simple moving average, is based on the close of the time frame. Today, they'll give you the high and the low divided by 2, the high, the low, and the close divided by 3. So they give you an average of an average price divided by. Then they'll give you OHLC, open, high, low, and close divided by 4. They'll give you a moving average of a moving average. Let's say when we're looking at a simple moving average, we're going to use the close. There's all kinds of gurus of market strategies that have come up with some weird stuff out there and say, if you take the moving average of a 10 period OHLC and then a moving average of a 10 period HL and put them together, and where they cross over, they'll get, it's really hard to know that stuff. But a basic moving average is a based on the close. So right now we haven't gotten past the real basic of the basic of the basic. But you have the understanding of what a moving average is at this point. From there, we can go to a more complex moving average strategy, which can employ a longer period and a shorter period moving average. And that is, in this case, I just happen to take a 10 and a 30 period moving average. Now, we could use a simple moving average crossover strategy. And really what we're looking at is very simplistic here. And just say when we have the longer and the shorter moving averages cross over each other, they give us buy or sell signals. Now we have to keep in mind that a simple moving average is what we call a lagging indicator. Because a simple moving average is using the last bar, the close of the last bar, to calculate the moving average. So what's happened is it's using all the prices in the past. So it doesn't have any predictive quality into the future because it's got to wait for that last bar to close. So it's a lagging indicator. Now, that's not a bad thing. Most indicators are lagging indicators. So they're a confirmation tool. They let us know that something has happened. Not too late that we can't trade. They let us know that the trend is one indicator might predict the trend is going to end, or another one tells you it has ended. Now, in an effort to make a moving average less lagging and more leading, we've come up with a moving average called an EMA, an exponential moving average. We've even come up with a volume weighted moving average. And then my newest one that I use most in my trading is called a displaced moving average. Now, what we're looking at here, let me add another indicator on here. Oh. Now I got too many of them on here. Okay. Now we're looking here at a 10 period simple moving average. Okay. Let's make this a little bit thicker. Okay. And now I'm adding to the charts what's called an EMA. That's the exponential weighted moving average. I'm going to put that in purple. Okay. The exponential weighted moving average is a more precise and more complex moving average. And what it does, it gives technically more weight to the most recent closes. So in other words, if you were looking at gold and gold was trading, you're looking, say, at a 10 period moving average, simple moving average, and gold was closed at 1250, 1250, 1250, 1250, 1250 for 10 trading sessions, you'd add them all together, take the 12,500, divide it by 10, and your moving average would be 1250. If gold in 2 periods ago jumped from 1250 to 1260, and in this most recent time frame jumped from 1260 to 1270, if we added all those together and plotted our moving average, it would probably be 1251. Nothing is taken into account that it stayed completely flat and then really started to climb in the last 2 periods. It's higher than the 1250, but it's only at 1251. An exponential weight moving average gives more cred to that 1260 and that 1270 move because they've happened in the most recent time frame. To do this, it's a more complex formula. So an EMA, calculating the EMA is a bit more complicated as this indicator gives greater weight to more recent values in order to reduce the lag effect. To determine this moving average, a trader should begin by selecting the time period. Now right now we're talking about a 10 period or 10-day time frame. And then we have to calculate its SMA. Next, now the 10 period SMA is simple moving average. Next, the investor should figure out the multiplier he will use to give the most recent data points greater emphasis. The size of this multiplier will depend on how long the EMA is, how many periods it went back for. It's a pretty easy calculation. The multiplier is 2 divided by the number of time periods. So we're using a 10 time period. So it's 2 divided by 10 plus 1. So for a 10-day EMA, we have 2 divided by 10 plus 1, or 0.1818, which is the multiplier we use to the current value, the current simple moving average, to add to it to place it on the chart. We're using a 20-day, it's 2 divided by 20 plus 1, or 0.952. Now, once this multiplier has been acquired, the following equation can be used to determine the EMA. And this is a little bit complex. It's the multiplier, which we found was the 18.18%, times the closing price, this current period's closing price, minus the previous EMA for the period before, plus the EMA for the previous period. And that together will give us the new 10 period EMA for the most current time frame. You never have to calculate it, it's just dropped on your charts. So an exponential weighted moving average puts more emphasis on the current price. So let's go back to our chart. So basically, we have the blue line on our charts, which is the simple moving average, And the purple line, which is the 10 period EMA. Now we can see that they do have some obvious separations and differences. And so it gives us a little bit better predictability, or makes it less laggy and more current. So we don't need the simple moving average anymore. Now, most people use an EMA. Again, an EMA and an SMA can be used exactly the same. So we could have an EMA and an SMA crossover strategy, which is what the most popular strategy for generating trading signals, trading alerts. And it's the most reliable. Now, a lot of people use a 3-period moving average for getting trading and alerts. So in other words, we could use a 10, a 30, and let's add another one, indicator, EMA. The site wants to constantly sell. Sell, 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 sell. Okay, so we could use a 10, a 20, we're using a 10, a 30, and say a 90 moving average. And there are lots of strategies that use that. And this actually does tell us a great deal. Now, whenever we're dealing with indicators, we have what we call short or fast, slow or fast. So whenever we're dealing with moving averages and the moving average in our calculation, we would call the fast moving average is the shortest time period. Because we say we're looking at 3 indicators here. We've got a 10, a 30, and a 90. The 10 period is the shortest period, and it's the fastest because it reacts a lot faster to the most recent price movements. The longer the period, the slower it reacts because it's moved over a very long period of time. And then we have the medium term period, which is the one that's in the center. So in this case, our purple line is our fastest moving average. Our green line is our slowest moving average. When we see something like the green move over the slow moving average, the fast moving average, and actually even breaks the intermediary inner average, tells us something. It gives us very unique trading alerts. And you can see how these 3 different moving averages actually interrelate with each other. And there's a whole bunch of material out there that you can read and learn about using 3 different moving averages. But let's go back to my PowerPoint because we're hypothetically using 10, 30, and 90. Okay. I've just made up those numbers. They're not a strategy I'm telling you to use. Because you have to learn what these time periods mean and how to use them. Now, just real quickly before we go on, one of the newest ways because of our new charts that we can use moving averages, and one that I'm finding or I'm using, and I usually teach a whole class on it, is called displaced moving average. A displaced moving average, let's turn these other ones off. Let's hide this one. In an effort to take the lag time out of the moving average, instead of changing any formulas, what we do is we offset it. We displace it. Now, I only use a 3-period displacement. So in other words, what it does It uses the same exact calculations, but it puts the dot on my chart 3 time frames into the future. So in other words, we're looking at the euro US dollar, and the most current moving average, instead of being placed right here where it would be in the chart, it's now placed on here 3 candlesticks forward. So it has to take now an hour and a half to reach it. So all we've done is we've shifted this line, and it's got some very unique results, and it becomes very viable. And it's an interesting scenario, and it helps me in predicting where the market might be going based on a moving average. But this is another type of moving average called a displaced moving average. Okay. Now, once you understand the calculations and the values of moving averages, we have to talk about something that's very important, and that's time frames. Because we've been talking about 10 period, 30 period, 90 period. Okay. Different time periods are very important, but where do you come up with them? Okay. Number one, it all depends on your trading. Are you a day trader? Are you a short-term trader? Are you an investor? Okay. Then it comes up with known variables that work together. You're not going to come up with some unique 42.5 with a 97.625 moving average that's going to revolutionize the markets and give you always, huge trading success. Just not going to happen. So there are standard time frames that we use. So in theory, there's an infinite number of simple moving averages. If you're thinking that you can come up with some weird 46 SMA to beat the markets, let me stop you now. It's important to use the most common SMAs and EMAs, as they are the ones that traders will be using all the time. They've been tested through time. And to come up with a unique prices different than everybody else, well, you can just blindly guess and throw a dart and say, I think Google's going to fall at 142.75. Well, I could come up with sooner or later some moving average that'll cross it at 142.70 and say, see, it worked. Now, while I do not advocate you following everyone else, it is important to know what other traders are looking at and what prices and levels are important to them. So we start out with usually the shortest period that a moving average is going to help you. And that's the 5-period moving average. And this is for hyper traders. Okay. The shorter the SMA, the more signals you'll get, but the more erratic they become and the more rapid they come. The best way to use a 5 SMA is to trade it, use it as a trigger in conjunction with a longer moving average. Then the most popular is the 10-period moving average. Okay. Now, when we talk about 10-day or 10-period, if you're looking at a 1-hour chart, it'd be 10 1 hours. If you're looking at a 15-minute chart, it'd be 10 15 minutes. So again, if you're looking at a 5-period chart, SMA, and you're looking at a 5-minute chart, that's only the last five closes over the last 5 minutes each. That's 25 minutes. Then we go to 20. So we've got 5, 10, 20. 20 is the last stop on the bus for us. Okay. We don't want to go beyond that because it no longer really helps our trading decision. We can go longer for environmental reasons. So we might use a 30 and a 60 and a 90, but they would help us decide whether we want to go short or long. They're not going to help us decide when we're going to want to get in the market or what price we want to enter. They give us environmental looks. Now 50 is by traders to gauge midterm trends. And 200 is, I don't know anybody uses 200 outside somebody an investor buying into the stock market. Now, some traders will try to tell you simple moving average trading systems where you buy and sell if price breaks the average on the closing basis. Unfortunately, this is not accurate. Oftentimes, stock will tick over or under moving averages to only continue in the primary direction of the trend. But now that I've given you just enough doubt before ever attempting to trade with a simple moving average, let's view a few ways that we could use an SMA. In the end, it comes down to what you're comfortable with and what your trading style is. Now, I say SMA, although in most cases I mean EMA. Okay. Most people today don't trade with a simple moving average. They use an exponential moving average. So the EMA gives you more and earlier signals, but also gives you more false and premature signals. The SMA provides less and later signals, but also less wrong signals. But again, I only use SMAs or EMAs and multiple moving average crossovers for alerts, telling me something is about to happen, telling me to look out at something is happening in price movement. So when you are a short-term day trader, you need moving averages that is fast and reacts to price changes immediately. That's why it's usually best for day traders to stick with EMAs in the first place. When it comes to the period and the length, there are usually three specific moving averages that you should be thinking about: the 9 or the 10 period. Okay, and you can choose whether you want 9 or 10. For instance, in MACD, MACD is the trigger is based on a 9-period moving average of the MACD line. Okay, but it could be a 10. But you decide what works for. Next, we have 20 or 21. That's the medium term and most accurate moving average. Good when it comes to riding trends. And the farthest out we ever want to go is a 50 period. There's still nothing wrong with using a 10, 20, 30 whole numbers. There's nothing wrong with using a 10, 30, and 60 or 30, 60, 90. But when you're going to 30, 60, 90, you're looking again at more environmental clues as opposed to entering a trade. So as I mentioned here, this is like I gave you on the chart. This is a combination of three moving averages. Okay, in this case, we're using a 21 period, a 50 period, and a 10 period. So the blue is our 10 period. That is our fastest moving average. The hot pink or purple, whichever we want to call that, is our longest moving average. That's a 50 period moving average. And then our medium term is a 21 period moving average, and that's the yellow. So we can see down here on the left where the prices cross all three MAs and a new trend starts. See where they're all crossed over and the new trend is starting. Now what happened is we move up, we get a shift as the moving averages are fanning out and prices moved above the short-term moving average, and now it's fallen back out into that moving average. Now a lot of traders will call this space in here dead man zone. They don't want to be in the market when it falls in there, and they don't want to make a decision when the asset is trading in that dead space. Now, as we see, the trend eases down and we get a crossover of the medium term and the short term, but it's held by that longer term moving average and bounces back above it. So in this case, this longer term moving average, the slow has supported price. It's been moving up, 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 and up. It stayed above this all the time. But once again, we get the moving average, the price breaking above the moving average, crosses below, now falls below that longer term. It's telling us something. It's not telling you to trade. It's telling you, hey, I'm smacking you on the back of the head. There's an opportunity here. Look at what the opportunity could be. So swing traders have a very different approach, and they typically trade on higher time frames. Remember, swing trader is looking most likely to hold a trade from anywhere from a week to 3 weeks to 5 weeks, some to 10 weeks, some to 3 months to 4 months. Just depends on where you are. Like I am not a day trader, although I'm a short-term trader. And I either short-term trade or I'm a swing trader where I'm looking to hold an asset for 10 I never hold anything more than 30 days, and I usually don't hold it more than 2 weeks. But a lot of times I'll enter a trade with the intention of being out of it in 5 to 10 days. So that's not a day trader. It's not a short term trader. You're moving into swing trading, but you're looking at a longer term approach. So the best periods for swing trading is a 2021, a 50, and 100 and a 200 period moving average. So how that is now changed because we're looking at something that's going to have a longer, we're going to be in a trade for a longer period of time. But now that you know about the differences between moving average and how to choose the right period setting, we can take a look at some ways of using moving averages. They will help us see trend direction and filter out what price is doing. So a 10-day EMA is a favorite indicator to determine the major trend. It's called red light, green light, because it's imperative in trading to remain on the correct side of the moving average. Established analysts use a fast EMA to stay on the right side of the market and to filter out trades in the wrong direction. Just one tip can already make you a huge difference in your trading when you only start trading with the trend in the right direction. So now here is an extremely well-known moving average crossover strategy. It's a combination of using a 9 and a 21. It's not mine. Okay. It is a standard, well-known strategy that is used throughout the markets. And that's a combination of 9 and 21. You could have used a 10 and a 20. Won't make much of a difference in the crossovers. Okay. But the known accepted one in the market is a 9 and a 21 day. And it's a directional filter. But even as swing traders, you can use moving averages as directional filters. We can also use moving averages as support and resistance lines. It's supporting price when it's above, resisting price when it breaks below. So it's another way of placing support and resistance lines. But the thing we have to remember is moving averages don't work in ranging markets. Now, most of the markets do range for most of the time. And moving averages are very inaccurate and don't. So when you see a market ranging and you're trying to trade a crossover to moving average in a ranging market, making a mistake. Now, like I said, we have indicators such as like Bollinger Bands that its primary center line is based on a 20 period simple moving average. And with Bollinger Bands, we would trade as we would ride the upper or the lower band, but we don't make a decision that that trade is ended or to move in the opposite direction until it's broken the center line or the moving average band. So you see that the moving averages are a multifaceted tool that can be used in a variety of different ways. Once a trader understands the implication of EMA versus SMA and displaced moving average, and the importance of the self-fulfilling prophecy and how to pick the right period settings, moving averages become an important tool in every trader's toolbox. For me, it's just something that's dropped in my charts automatically when I'm trading. Let's go back to some live charts here. Okay, when I'm trading, there are certain things that are always appear on my charts. I will always have a trend line on my charts. I'll always have my moving averages on my charts. And I will always have my support and resistance on my charts. Okay, they've got nothing to do with strategy. It's what I use to when I look at a chart to quickly make sense in my head. Whether I'm not making a trading decision, but by looking at those three things together, every 15 minutes, every hour, then tomorrow when I look at it, they're all drawn on my charts. I can tell you what that asset's doing, what the markets are doing, and what to expect happening in the markets. Okay. So these are items. Let's take the rest of this off of here. Okay. So on here, you can see the trend lines have been dropped down, support and resistance lines. And then all you have to do is add on your moving average and not as a trading strategy, is simply a interpretation or a understanding when you're quickly looking at a chart what the market's trying to tell you before you're ever getting ready to look at a strategy on and make a trading decision. We're not talking about trade. We're just talking about quickly seeing what price is trying to tell you what's going on in the markets. Now, if you look on your screen, there's a little place that says handouts. I've put together two handouts for you. One of them is called Moving Average Guide handout. I've put together everything we've talked about in class. Okay. And there's some graphics in there, some content, but it goes over everything we talked about today. Okay. It's in a PDF format. Just click the download button. There's nothing you have to register for, nothing you have to sign up for, no password. It's yours. The second thing I put in there is the technical analysis guide from investing.com. That is an excellent resource guide. It goes over everything with technical analysis. So moving averages is one of the beginning basics of technical analysis, along with support and resistance and trend line. And it'll take you over all the indicators, all the strategies, understanding chart patterns, and all the different fields of technical analysis. Excuse me. And again, you can download that. It's free of charge. There's nothing you have to register or set up for. Just click the button. It's downloaded to whatever device you're using, but it's only available in today's live class. It's not available in the recorded version, and there's nowhere else to access it except in today's class. So thank you very much for joining us. Thank you for supporting Alvexo. And if you do have any questions, you can go over to www.alvexo.com and use their live chat button, and you can ask, they'll answer it for you. They'll set you up and talk to a financial analyst or a technical analyst who will be more than glad to answer all of your questions. So you can email them, you can use the live chat, you can SMS them, whatever you want to do. Just go over to alvexo.com or go over to their education section and look it up yourself. So thank you very much. Have a great trading day, and thank you for supporting Alvexo and investing.com. Bye now.